Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 18th, 2021. It is 12:33 p.m. Eastern Time as I'm starting the video, so we're about halfway through the trading day. What I'm going to do is a brief update on the equity markets, look at those, large and small caps. Then I want to just highlight or update really some of the recently highlighted trade ideas, the ones that stand out right now, anything actionable or notable. And then some new setups in the financial sector as well as the energy sector. So let's start out here again. Quick update here, so I can get into the energy stocks and the in the financials a little more in detail in this video. On the S&P 500, we're looking at ES, the futures for the S&P 500. This is that we had this primary trend line here. That's when our sell signal was triggered back there. And then I gave you the secondary trend line, which it's decent. I'm not crazy about it because you had a violation back here, a little pop. But as I said, most recently we've been walking up that trend line. And so we broke down, back tested, and we're back testing it right now. So that's it. And we're also at the previous highs. We've had multiple failures here in the S&P. So that's it. I'm not crazy about the price action, especially with the NASDAQ 100 still being strong. But it is what it is. We have a breakdown, a sell signal. The markets are still on a sell signal. And then we had a secondary sell signal with the break of this secondary trend line. And the divergence is still very much intact. So we still have everything, all the check marks I want to see for a sell signal. And those are your targets on the ES right there, 45.87, 45.45. And of course, they're the actual support levels where reactions like. I'm going to give you one more if you like to, if you're an active trader. We'll most likely get a bounce here at about 46.27. That'd be our first reaction there. If you want to try to game any pullbacks. And as always, take a shot, and your stops would be in line with where you think the market's going. All right, let's quickly move on to, we'll look at SPY for you real quick. I haven't covered that one in a while. Here's what I have on SPY. There was our rising wedge right there. That was and there was our sell signal. And so we came down, and it's an alternative trend line I have on SPY. It's a little different from the one I just gave you on ES, but same story. We're still, the divergence is still in place. We're still we're at or below. We're actually right around where we were when we peaked before, and that's what tends to happen. You break down, you either have a sharp leg down, but usually there's a counter trend rally somewhere in there. This one came early on, and so now we need to break that trend line right there. QQQ. We're still holding. There's the primary trend line that we broke with our sell signal right here, and then I gave you the secondary uptrend line, which is pretty well defined, no violations there, and we're still above it, and we're still basically testing that previous high, so we still have the negative divergence. In fact, when you look here on the 60-minute chart, the divergence is even steeper now, it's paving the way for an even bigger drop. So I still maintain these targets that I laid out before, T1 through T4 down here on QQQ. You can see them a little better there. And again, this is the trend line. Let me color it up for you so you can see it nice and clear. I'll make it yellow. That's the trend line we need to break right now. And there's our current divergence. Even if we go a little higher, quite a bit higher, we're still very much going to have that divergence in place anytime soon. In other words, it's not at risk of being negated anytime soon. Alrighty, and then last but not least, small caps. I already gave you an update today on a screenshot, but I'll just pull that chart up right now. RTY, Russell 2000 small caps. And this is the 2-hour chart, same one I showed you before. Here's the sell signal I gave you back here when we broke the bearish rising wedge, when all the indexes fired sell signals at the same time, same day. It got you short, and so far so good. Good for about a 4% gain in the small caps in futures if you traded those. That was the first target that I laid out there. 2340, about rounds off to 2342, but as always, you cover a little bit before the actual support level, and that's actually where we reversed just a hair, a fraction of a percent above it. So you were able to get out and, as an active trader, game the bounce. And the fact that we've already hit this level, since I gave you when I gave you this chart back here when the sell signal triggered, I didn't have this line. This line set up the 2383 level set up as support here because we had a reaction, another reaction there, and then we broke it and we back tested. So that was an objective shorter add-on when we back tested or when we broke down. And the fact that we've already back tested it once leads me to favor that we may not get all the way up there again. Look, if we do, still an objective short entry, just as it was yesterday on the back test. But the fact we've already broke and back tested it once tells me we may just, this bounce may be it. And so in the arrows I drew, and those are just rough estimates, the arrows on bounces, on the counter trend bounces. I'm talking about the bounce that I drew on the chart I gave you this morning off the 2342-ish support, was coming in below that 2383 level. So you can take a shot here, reshort, add back in, get a new short, or play it safe and wait for a break above 2342, and then the next stop should be that downtrend line right there again. If pretty much those lows, call it 2340, gives way. And the Bitcoin short continues to play out. You had this divergent high here, bearish rising wedge right there. 60-minute chart that you're looking at on Bitcoin futures, BRR. There was your breakdown. And a lot like maybe the NASDAQ 100 might do. Right now it's an equal high, but this one put in a marginal new high. And in doing so, that marginal new high right there was simply an extension of the previous divergence that got even bigger. And then the correction started, and then just like I gave you on the indexes, we set up a secondary uptrend line, which was then broken and back tested. That's the one I think I gave you the sell signal on recently right there. So you broke down, back tested, and it's playing out well. At the first target, we had a little consolidation around there, that 6,800 level. Then we broke that. We went to my next target, 58,315, had multiple reactions on it, bounced back, gave you plenty of objective reshorting or new shorting entries at 6,800 once again on the back test. And then boom, we went and broke down. And now we're back testing. We broke it today, the 58,315 level, and we're currently back testing it, or a hair below it. You can see right there. Simple stuff. That's a breakdown. Ideally, that breakdown holds, and you're close enough to short to swing down to that 54,745 target. And again, I know a lot of you, or some of you, might not trade futures, so that's why I give you GBTC, the Bitcoin Trust ETF type instrument, 60-minute chart, divergent high, and you can see we just broke that 4643-ish level today. We're currently right there, just a hair under it, so still offering an objective short entry for a swing down here on the 60-minute chart to about 41, 44, 45 if you want to round up a penny or two to be safe. And that's what it looks like. I know that's very, very busy, but there it is. Covered this quite a bit. We've had multiple failures at this 55.66-ish level there, and all the better, like it was here and here. You had negative divergence just like you did here, and those were profitable short trades laid out at the time, and I think this one has more downside to come. And finally, on a related note, ETHE, of course, also is the Ethereum ETF type instrument, and that you just had a beautiful bearish rising wedge, and you had a failure with the breakout there, and playing out down another 5% today. And I've already laid out my targets for you, so nothing's changed there. Still looks good. Next up, let's do an update on coffee. I threw that one out to you yesterday. I like that one. Was just take a shot at it because you were at long-term resistance. That was the objective entry yesterday, and then today we went on to break the 60-minute trend line. This is again that 60-minute chart of KC coffee futures. You had the divergent high on the 60-minute, of course, right there. Divergent high, and then boom, there's your sell signal. So now, to me, at least, it's an all-in short. If you took a starter position yesterday at long-term resistance, you could add that, take it up to full position today when we broke down. Again, first target, and that's going to be, I think we're going to come down at minimum. There's a case for a much larger correction in coffee, so I might just let this one run for a while. But first target's 23.50, and then to about 215, and I think we'll come at least to that one there, and that's going to be about off the highs, right at about a 10% drop off yesterday's highs. So let me fix that divergence line there. It's bothering me. Moved a little bit. There you go. yeah, I guess since I did the video yesterday, it went up a hair higher, increased that divergence, and now the divergence is confirmed. So solid sell signal on coffee. And again, for those that don't trade futures, you have JO as your coffee ETN, like a cup of Joe. And there's your nice bearish engulfing candlestick right there today. So far in play. Now the day is not over, but it will be soon, because coffee futures, even though this Joe will keep trading, you can buy this up until the market closes. Keep in mind, coffee futures close a little bit before the market does, so Joe usually kind of goes into a holding pattern at that point because the futures have stopped trading. So what I'm trying to say is you will most likely get that bearish engulfing candle today, and then all the better I like to see follow through the next day. One or subsequent red candles, and that will help to confirm the nature of that bearish engulfing candle as a potential topping stick. Let me just give you some swing targets on Joe. Right about here, 52.80, yeah, 52.82. No, that's 58. I'm sorry, 58.82, and then the uptrend line. We'll probably come on back to at least to that uptrend line down there, and that would be off the recent highs. If I can grab that candle, I'm going to have to move to the right of it a little bit. Oh, okay, I'll be a little bit below it, and I'll have to drag a little below the trend line. That'll be about a 12% drop, so roughly in line with what I was looking at on the coffee futures. And again, revisit the update I did in the video yesterday, putting us at my long-term target from a couple years ago. And so therefore, I think the potential is for a much larger correction in coffee. Even though I believe it's in a bull market with more upside to come, the corrections in coffee are going to be measured well into double digits. And so we can go on to ultimately break this uptrend line. Remember, you have big negative divergence here on the daily chart. So, that could bring us all the way back down here to about that 47-ish level right there. That's good support. That's certainly a possibility, and that would be a drop of about 30% in coffee. So that's let's just say roughly 30% long term. If you want to try to hold out for the big move in this one, I think that is a possible target right now. Energy sector, my views on crude oil. I've updated that as recent as I believe yesterday, and so with crude, the energy stocks will follow. We had a divergent high right there. You had a correction. We highlighted this as a short trading op, broke trend line support there, went in to put in a divergent low. At support as well to boot, highlighted it back at the time, and that was a catalyst for this bounce, and we made a marginal new high. In other words, just slightly above where the energy sector peaked all the way back in June, and you can see that we have a little shelf of support there. That previous high was right around 57. Zoom in real tight, and look at this. Look at how we've been dancing on that 57 support for weeks now, actually going back to early October. Look how many perfect tags of those candles on there, so many of them. And we had an intraday break, holding the line right now. I'm trading as we speak at 57.18. That line is, call it 57. I say 57.07 is where I have it on my chart. Okay, so that's just a daily chart, but now let's zoom out to the weekly chart. Let me show you something. This is XLE, the energy sector ETF. And what stands out to me is we have some big divergence. There's that last divergence I pointed out a few months back. We had that short trade. We came back and back tested this trend line. That was also support there. Price support 46.80. But we went on, and now we have even bigger divergence in place. We had divergence then, and it's even larger now. And you might say, well, yeah, Randy, but look, we popped above $54. We're above that now. And yeah, we did. I can also extend this, not that one. I want to leave that trend line there. I want to extend that trend line and show you that's a perfect back test of that trend line right there. But I'm going to show you something even more compelling, at least in my book. So there it is, a back test of resistance, negative divergence, and this is swing short stuff, even trend short. I think you can put a short on the energy stocks. I think energy and financials right now are the two of the most bearish sectors in the S&P 500. There's 11 sectors total. These are both in there, and so there's one. I would short it now, and then add to it if it breaks that support level I was just showing you on the daily chart there, 57 or whatever. Now, okay, so what makes it more compelling? This XOM. This is the 800-pound gorilla in the sector, and I'll have to check it. It's been a year or two since I've checked it, but I've traded XLE for many, many years, and in the past, two stocks, the two heaviest weighted and two largest energy stocks, ExxonMobil and Chevron Texaco, were by far the largest. They made up well over half of the performance of XLE. So, in always said it's important to know that. So no matter what the remaining stocks do in XLE, just two stocks are going to determine where the XLE goes, and that's this one in Chevron. We'll get to those in a second. So, okay, what's compelling to me here? This is a big level. I've had this line here forever and a day. We're on a weekly time frame, just like we were on XLE a minute ago on the last chart. This was a big level. It goes back many, many years. Most importantly, as with any trend line, what did it do in recent years? Major reaction low there. Another major reaction low. Again, you're looking at log scaling. These are double-digit bounce. These are big trends here. And then you can see holding that level, holding for months, testing that level. And when it finally broke, it didn't just limp around. The bottom fell out of energy. Did it align with COVID? Yeah, it absolutely. But it doesn't matter. The charts are the charts. The same technical, the forces that you make technical analysis work. It doesn't matter quite often, and usually there is a fundamental catalyst for bullish breakouts and bearish breakdowns, and that's what that was. But argue about it all day long. What is hard to argue with anybody is that was not a very significant support level. And the way it works in technical analysis, support once broken becomes resistance. So that's it. We'll end it there. ExxonMobil, the largest component of XLE and the energy sector as a whole, big negative divergence. You have it on the PPO histogram, the PPO, the RSI. And you're at resistance, and that makes for an objective short entry. You got to give it a little bit of room because there's a little room to go up. If I zoom in really tight, ExxonMobil could certainly run up another 5-6%. So if you're looking for a significant top, you need to allow for a 8-10%. Let's say you do a 10% stop loss allowance, you're targeting a 30% drop. That's a 3-to-1 risk reward ratio. That's attractive. CVX, again, the number 2 in the sector. Beautiful downtrend line. I mean, this trend line comes back to late 2017 right here. That's where I have it generated off of with numerous reactions since, and that's where we're at right now. So not only are we at a significant long-term downtrend line resistance, we're at that with overbought conditions on down here on the RSI and negative divergence on just about any indicator you want to put up. So that coupled with my bearish outlook for oil says this is one of the best sectors. I like it now. You can go, you can short any or all of these. There's certainly, and I'll go through this. I'll do follow-up videos and go through individual components, give you individual trade ideas. But your energy sector ETFs or XLE, of course, you get more bang for your buck usually going with XES instead. That's the oil and gas equipment and services, or XOP, exploration and production. And they all, the charts are all very similar. These guys follow each other. Again, it's just think about higher beta, more bang for your buck if you get the call in the energy sector right. Usually this one's going to go down more. And XOP also has some leverage and inverse options as well, which are, DRIP, I believe. Yeah, DRIP is the 2-time bearish exploration and production ETF. And so you can look here, it's just going to look like the XOP in reverse. You're going to have, instead of negative divergences, you're going to have positive divergences. And I'll give you a rough target now. I'll have to certainly give you additional targets, but about 2070 right there, roughly 1225. And there's a reaction low there, 665. So these targets, if hit, that would be my minimum there, and that's going to be about a 37% rally from where we're at right now, or today's highs to that first target. And if you want to hold out for the juice, second target would give you about 154% return. And that is aided, of course, by the leverage. And you're going to get some decay on these charts, so I'm not going to really give you a downtrend line, and just there's an idea for you. So energy sector, and then before I roll into the financials, I like the euro. I like that a lot. Started taking building position yesterday. Big divergence. It just got the snot knocked out of it when those hot CPI numbers came in the U.S. 31-year inflation. So everyone's figuring, okay, Fed's going to have to raise more aggressively than they've been talking about, which yeah, of course they will. well. But hello, you know, sooner or later, and I haven't followed the headlines, it doesn't matter. There's just a beautiful back test of this trend line extended. You have this divergence line. You're coming in there. You're extremely oversold. Positive divergence, and we're going to go up to at least that, I believe, at least the 114.41 level, and most likely the 115.45 level. That would be, those are your two swing targets for the euro. And what I was going to get at is, yeah, what I said before is, yeah, sure. Fed's going to have to be a little more aggressive now to put the brakes on inflation, but so will the ECB. And when the ECB comes out and says or does something, then that's going to cause a spike in the euro. Maybe they already did. I don't know. I haven't followed the headlines on it, but I don't, you know, I'm going to trade first and foremost off the technicals. All right, next and last up, and then we can move on and wrap the video up. Oh, no, before I do that, I just want to say I still like, you know, the bonds. This is which one is this? ZF. The 5-year note still looks very nice on this 60-minute chart. Positive divergence. It needs to pop that 121.211 level to run, and I think it will. That'll probably coincide with a pullback on equities. ZN, your 10-year bond, positive divergence, starting to move up. I already gave you targets on that. Let's just say up to at least 131.258 right now. And ZB, the long bond, you always get more bang for your, typically you get more bang for your buck on the longer duration bonds. So the 30-year, again, just all of these bonds, Treasury bonds coming off oversold readings right here on the RSI, and positive divergence, and so far so good. And there's your next stop up there. Okay, XLF. I could talk on this one forever, and I'll keep it truncated because I've already covered a lot of things in this video. We'll end it here with the financials. So lately, the buzz that I've heard quite a bit on the street is where, you know, the longer term outlook for the financials is bullish because we're looking at rates going up, and that benefits banks. They increase their margins. The spread, you know, the spread, a bank, you know, turns around, they give you virtually nothing right now on your savings and checking and money markets and CDs, and they're turning around and loaning that money out in car loans, boat loans, mortgages. And so when the long-term rates go up, or interest rates go up, their spreads widen. They can quickly raise the rates on those loans, and they'll drag their feet on raising your deposit rates, and they're making money. Okay, so that's the fundamental reason. But yeah, you know, whatever. Charts rule. And first of all, we don't know how the economy is going to play out. So they're talking, yeah, in that world of a rising interest rate, sure. But now, should the economy hit the skids some point soon in the near future, well, you're going to have a lot of those loans default. You're also going to have a slowing demand for loan growth. So there's a lot of variables there, and you can sit there all day long, and that's what the Goldman Sachs analysts are for. They're fundamentals. So you can read their, you know, or any analyst's thoughts. I just gave you kind of the nitty-gritty on the fundamentals of how banks work, but I go off technicals. And if you recall back here, I put a sell signal, which I believed to be at the time the top, and I thought it would also give us a top in the markets. And I talk about this a lot on a trade. There's two things. Now, I'm not still in this trade now. It's just it hit T1 and it's just bored me out of these stocks a while back. There were better opportunities. But as far as making a macro call, longer term call, there's, you know, a difference in my opinion on any call that you make or a trade of being early or wrong. And the difference of being early, let's just say that I, you know, positioned for this for long term and I shorted on the sell signal right here. And I was targeting, let's say, here, that third target right there, right? Okay, so I'm going to measure it out for you. So that third target was, it was and still is 31.35, a 20% drop. So therefore, I could allow a good, you know, 7% stop loss. Well, the from the high right there, and from the breakdown, we've only gone up about 5-6% or so on XLF. It's been a marginal new high. So everything that was in place before, or at least the negative divergences that were in place there, they've not been negated. They've only been extended. They're even larger. You have this primary uptrend line now to watch. That's going to pull that in. I need to pull that in a little tighter, a little closer to prices. There you go. And that's just forming a big, here, let me show it to you on a clean board. It's just showing us a big wedge, and this is also going to show very clearly on the weekly chart. So again, I believe this is one of the most bearish looking sectors right now, despite what a lot of analysts out there think. And we're going to just rifle through some of the weekly charts, and I'll give you trade ideas and more of an overview of the sector. Okay, here's a weekly chart of XLF. And again, you can see clearly that divergence that's been building. Here it is on the histogram, the PPO histogram that is. There's the PPO itself, clean, big negative divergence, just like you had divergence back here when the bottom fell out. And you have a nice clean uptrend line. This is a big bearish rising wedge pattern, and it's on the weekly time frame. So when you're looking at chart patterns, bullish or bearish on the weekly time frame, I'm looking for trend changes and not quick 3, 5, 10% swing trades. I'm looking for trend trades that are going to last months and sometimes even years. So when that breaks, when you see a solid break of that uptrend line, that's going to trigger a even more significant sell signal than we had back here at the last time we broke down. In fact, that one again played out, hit my first price target, but bounced from there. And so far, like I said, it's made a slightly marginal new high. Targets are going to be down here at about 35.15. That'd be about a 12.5% drop from where we're at. And my preferred swing target, where I think we're going before all said and done, once we get that trend line break to confirm the sell signal, we're going to drop down here, I believe, to that 31, 35-ish level. And you're talking about a 21% drop in the financials, and it would be extremely unlikely to see that happen and see the stock market continue to roar onto new highs. So there's my analysis. Now I will go through just a handful of I'm just going to go through the components of XLF in order of market cap. So kind of keep in the back of your mind that the bigger the market cap weighting, the bigger impact it has on the index as a whole. Here's JP Morgan. It's kind of a busy chart, JPM, but you can see negative divergence. That's when I pointed it out last time a few months ago. We got the drop. We hit my first target. And then there's a common theme I'm seeing in a lot of the financials and really in the stock market and a lot of sectors. And the term I use for it, maybe my Latin's a little rusty, but I call it Ursa interruptus, which means interrupted bear market. Right here we had a multi-year. This was a primary bull market trend line, comes off the 2009 lows in JP Morgan. You're going to see something similar in XLF, a lot of the other stocks. It was super well defined, so many reactions along the way. Again, you have intermediate term trend lines or shorter term trend lines than the primary. Primary trend line was broken when shortly after the top when COVID hit. So again, it was priced, the correction was priced into the charts technically. We had divergences building for years, and COVID was just the catalyst, the fundamental catalyst, and it played out for one of the biggest bear markets in years, and this stock dropped 46%. So certainly a bear market, got chopped in half. But what happened is the Fed came in with the nuclear response, and again, in many sectors and in many stocks like this one, interrupted what should have been by all, by the charts, a bear market. You had a leg down, you came in and back tested the trend line, you went down again, but so much money and fiscal and fiscal stimulus of all types from all central banks around the world came into play, and it caused that primary trend line to be regained recently. And again, now we're sitting right on it. Point is, I still think it's valid. I think when we break it again, that's going to be a powerful sell signal. You can see I'm zooming in. Here is that trend line right there. And then you have below it, so the levels to watch on JP Morgan on this long-term weekly chart. Looking for weekly candlestick closes below those would be that long-term trend line, which we're close to now, and then this secondary trend line here. We've set up this like wedge type pattern, and that would have longer-term bearish implications, take it down to about at least 119. So let me just give you that as a long-term target. Near-term, intermediate target, I think will come down to about this 141-ish level right there. But there's a lot I need to cover, so let me just rifle through these so I don't spend too much time. BAC, Bank of America, same thing. There's your primary bull market trend line. That was a major sell signal. In the stock, it's not like the stock didn't drop a lot, but it's been flirting with that trend line since, back testing, negative divergence. Same story. So we have these weekly divergences. There's that secondary trend line that I think will come into play at some point in the coming months. Probably be in 2022 before we hit that. We'll see, but that's certainly a target, and there's support right there. So again, the point of this video wasn't to give you all the levels, just to kind of give you the overview of the technical posture of the financial sector. Berkshire, there you go, negative divergence. There's that uptrend line. See, this one is right on the that secondary uptrend line. Remember those banks that I just showed you, they have a little room to hit it. Berkshire starting to crack it. In fact, starting to crack this week. You know, it's not going to melt down until the whole sector starts rolling over as well. But there's a breakdown, a sell signal if you want on Berkshire right there. And same story. I can go through them all. And I will, you know, later in another video. I'll sniff out some of my favorite ideas. I just wanted to go down about the top dozen of these financials again in order of market cap and show you. This one's already triggered a breakdown. Morgan Stanley, negative divergence. Schwab, nice looking one. I think this one has a lot of room to fall. I think it'll come to that trend line as well. Big negative divergence. So how much downside do you have in Schwab? Depending on if and when it gets there, about 25%. There's going to be a stop along the way first right here, about give or take about 67.40. And maybe those levels come in together. Maybe it's a slow roll and it goes like this, and you hit it. Okay, so let's say that. Then you're still talking, even if we go up a little more, and that's fine too, you're still talking about a 17, almost 18% drop to get there. BLK, BlackRock. Same thing, divergence. Primary, you know, this was our primary bull market uptrend line, broken, back tested for a while, and above it now. So break it again, it could take us a lot lower. AXP, beautiful, just so many nice setups right now, and some of these have already broken down, and that's American Express. Citigroup, chart's a little busy. I don't have a lot of lines updated on that. Goldman Sachs right there, GS, SPGI, that's S&P Global. That one's already cracked below the trend line right there. So this one's technically on a sell signal. You're just going to need to see some of the banks break support. But there it is, broke down, back tested, rolling over. And again, I think it'll come back. This one is one that never took out its bull market uptrend line. There's the uptrend line from 2000 and late 08, early 09, and that would be a target. And look, you can be longer term bullish on, you know, the U.S. economy and the market, and it's healthy to see this one every so often. When you have bull market uptrend lines, those stocks are going to come back and they're going to visit that. They're going to check that trend line, and look how long it's been. It's been a while. So just to have a correction to back to the bull market trend line, it's going to take this stock down about 38% or so. USB, what a nice looking setup. One of my favorites. US Bank Corp sitting right there on the trend line. Negative divergence across the board on all your indicators. Popped out, and this is going to be a breakout, a failed breakout of that previous high, and that one, once we break that trend line, minimum, we're probably going to come down to, I think at bare minimum, 54.45, and certainly some potential for more. Let me just give you an additional target just because I can't help myself. About 47 right there. All right, PNC, just look how nice that setup is. Look at that big divergence, beautiful, clean, well-defined uptrend line, and ready to go. So a little more downside. Just watch these financials. If they start to roll over the next week or so, you're going to have a lot of breakdowns, and you're going to see a lot of sell signals firing off, stops being hit. So there's one of my favorite sectors, TFC, Truist Financial, and last one I'll do, CB Chubb. Same thing. Look at these clean up trend lines. Many of these are still above trends. I do have to say that. It's certainly not an all-in short sector. I think you can either start scaling in now, which is my preference, or wait for the additional sell signals. Your entry price is a little less favorable, and you know, as long as it doesn't happen on a bang where, you know, everything drops so fast it's too late for you to get in, that's always a possibility, and that's why sometimes I like to start building positions early. So there it is, financial sectors, and I will end it on this, that XLF is just the as the name implies, a financial sector ETF, and that has banks, insurance companies, big holding companies like Berkshire. But you also can trade the banks directly via BXK. No, that would be BKX. BKX. And so this is the KWB bank sector. This has, BlackRock and, a lot of the big ones in there, and well, many different banks. And you have this clean uptrend line right there, divergence line, negative divergence, boom, 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 boom. Just like you had, there was divergence right there at that peak, right at the high, fell off there. Here was a comparable pattern right there. There's a wedge. There was a sell signal. Didn't go. It hit support for a while, danced on support, just like the equity markets right now. The sell signal remained intact for a long time on the weekly chart, and then finally, before it gave up the ghost, once it did, and that was back in 2018 into the end of 2019. Before all said and done, the sector fell about 26%. All right, and so right now, the scope of this wedge, if you look at a bearish rising wedge, take the widest part of the wedge, add that to where the wedge breaks down, that gives you a measured target. So, that should take us to at least the 115.46 level right there in BKX. And then the other one, if you want to focus on the regional banks, you get more bang for your buck there. They tend to fall more when the banking sector falls. Those are they're big banks, they're regionals. Fifth Third Bank, PNC, Huntington Bank, Regions Financial, Key Bank, those are all regionals. They're all in here. And there's your similar pattern. This one's still not triggered a sell signal, at least not on the weekly chart. But then what I do is I zero down to the daily chart, and I haven't updated this in a while. What I see here is a breakdown and a back test of the primary trend line. And the divergence that was in place back here, just like the big banks that I showed you before, these guys have made a marginal new high and kept that divergence going. It's only bigger back than it was back then. All right, we will wrap the video up here. In summary, currently bearish on financials, bearish on energy, bullish on the euro, bullish on bonds. What else? Bearish on cryptos. And I think that's it. I think that's what I covered in the video here. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. And again, a reminder, I will be in the office through tomorrow and then out all of next week with limited, if any, internet access on vacation. So if anything big happens, I'll make a point to get to a computer or a phone and post my thoughts. Otherwise, might go dark all of next week.